All right, let's get into chapter 9. It's exciting because we're just checking things off here. I wanted to start at the feature story, the pharmaceutical story at the beginning of the chapter. And as mentioned, I'll be checking your notes in at the end just to see how you add to them. I'm not going to read the whole thing word for word, but hit the high points and kind of try to wrap your head around like the complexities of working with AR where there's so many millions of dollars worth in sales. So the feature story begins with a dose of careful management keeps receivables healthy. And it begins with a quote. Sometimes you have to know when to be very tough, and sometimes you can give them a bit of a break, says Vivi Sue. She's not only talking about her children, but the customers of a subsidiary pharmaceutical company, Whitehall Robins, where she works as a supervisor of credit and collections. I'm just going to paraphrase and read what I had originally highlighted. If you want a good relationship with your customers, but you also need to bring in the money. The money in the Whitehall Robins case amounts to some $170 million in sales. Nearly all of that is on credit. So wrap your head around that for a minute. I mean, the pharmaceutical business industry is obviously a huge part of our world. And so if you think about $170 million in sales every year, and most of that is charged with AR, that is a lot of, you want to keep a good relationship with your customers, but you also need to bring in the money. I'm going to pop over to the other column. Once accounts are established, I get an aging report every single day. The rule of thumb is that we should always have at least 85% of our receivables current, meaning they're billed less than 30 days ago. So in other words, they want almost all of their bills going out, and mainly those people are paying their bills. We try to do even better, and we'd like to see 90%. At 15 days overdue, so you've sent a bill, 85 to 90% of them are on that 30-day rotation, and at $170 million in sales a year, you're going to want to keep a thumb on that. So then what happens? What happens when we start having things overdue? Here's what this particular company does. We first call them. After 45 days, they send a letter. Then a second notice in writing. After the third and final notice, the client has 10 days to pay, and then I hand it over to an outside collections agency. So let's just take a look at the dates there. Okay, so you've billed them 30 days. Okay, at 15 days overdue, so 45. Another 10 days, about 50. You're looking at getting them sent off to a collection agency. That's a lot to manage. What we're going to talk about tomorrow is, do we write them off and say we're done with you, or do we allow some hope, or we call it the allowance for doubtful accounts? Receivables are generally the second largest asset of any company, so it's no wonder we have to keep a close eye on them. That leads into the chapter. We're going to actually cover the first part and a portion of the second part today. Let's just revisit the meaning of receivables. Okay, this is where you'd want to find your notes, highlight, and add to them as necessary. Receivables can be described as amounts due from individuals and other companies that are expected to be collected in cash. I would say they're high up there on the liquidity ladder because we're going to get cash for them sooner than later. So it's a matter of we own the right to getting paid from either individuals or companies. That's why it's an asset. We learned about that very, very early on in chapter 1 and 2. There's 3 types. We're very familiar with accounts receivable, or smaller amounts owed by customers that result from the sale of goods or services. So we're either selling stuff or services. I would say that's a 1 year or less IOU. Notes receivable, however, are claims for which formal instruments like a loan of credit are issued as proof of debt. So typically I'd say ARs are shorter in length, notes receivables are longer in length. The book also describes what are called other receivables, or non-trade. Even in my notes, I wrote non-tangible. So stuff you can't touch. Loans to officers, advances to employees, and income tax refundable. I'm going to reread that part of the book with you. Other receivables include non-trade receivables, or what I just listed as non-tangibles. These do not generally result from the operations of business. So it's not like we're selling trinkets and these are a form of a sale. I want to point out that they do not generally result from the operations of business. Therefore, they're generally classified and reported separately on the balance sheet. So it's like people owing us money, but it doesn't have to do with the livelihood or nature of our business. Why would you borrow money to employees or give loans to officers? Well, some businesses do. What does this look like on the balance sheet? This is in your book. It was right on page 430. I didn't give it to you in your supplemental notes. But again, what's the definition of a receivable? It's listed there again. This takes a look, actually it's not what it looks like on the balance sheet, sorry. These are just a variety of companies, and if you look at their receivables as a percentage of your total assets. So General Electric, oof, my pen's off today, yikes. General Electric, out of all of their assets, 52% of them are ARs. What's scary about that? Ira said it well, more than half of your assets are not currently in your possession. Out there floating. That should be scary. You better have a really good AR department to recover those. Ford Motor Company, 42%. 3M, which I don't know if you knew what 3M stood for, but it's a Minnesota-based company for Minnesota mining and manufacturing. Did you know that? Okay. You see a huge decrease there, 14%. DuPont, 17%. And Intel, only 5% of their assets are out there floating. Interesting. So it just gives you a breakdown, which is kind of interesting to take a look at. We will run some AR ratios later in the chapter to kind of try to figure out the health of a company and analyze it a little bit. So that was really all that the first section was about. Moving on to the second section, we're going to do some journal entries together, but then we're going to stop because I'd rather teach you about all these uncollectibles and bad debt and all that business direct write-off tomorrow. So let's just crank out a couple journal entries, and this is where your supplemental handout will come in handy. Recognizing accounts receivable is pretty straightforward. Someone wants to buy something, you say, are you paying on cash or are you paying on credit? And if they say, yep, we want to have you bill us, that's what it is. You recognize the AR at the point of sale. Okay. One thing that I really want to stress, and I put it in red on here, and you might want to highlight it and make a note on the supplemental handout that I give you. If you think back to chapter 5, yeah, chapter 5. Chapter 5 is when we sold merchandise on account. Okay. We were buying inventory and then we were turning around and selling merchandise. If you remember that process, anytime I said, you see the word sale or sold or sell, it's 2 transactions. Do you remember that? You'd always do your sale, and then you'd always list inventory out and cost of goods sold going up. You remember doing that 2-part transaction? Well, this one has a note right in the book. These entries are the same as what we did in Chapter 5. However, the book says for simplicity, the inventory cost of goods sold portion of the transaction will be removed, not only in the book, but at all the under chapter activities, including the test. So although I said anytime you sell, it's actually 2 transactions, now the book's saying, meh, we're going to forget about that. So just wanted to point that out. So assume the Jordache Company on July 1, that's important to know. Oh boy, I'm going to quit fighting with my smartboard. Sells merchandise on account to Polo for $1,000, $210 and $30. Record the journal entry. It's something you are used to doing. What went up? AR. We have an asset that showed up, sort of. The asset piece of it is we own the right to getting paid this $1,000. And then you see sales revenue also go up. You're going to learn about another kind of revenue today, or be reminded of it. So if we sell something and they did not pay cash, it would be AR going up and sales revenue going up. What would this transaction have looked like if they would have, if Polo Company would have paid cash instead? What would have been the debit? Cash for $1,000. Okay, but keep in mind this whole chapter is about AR. So you might say, seriously, that's it? Like we know how to do this already. You own the right to getting paid, yes. Well, we're going to get into that in the second half of this chapter. What happens if it's the 15 days, 10 more days? We're looking at almost 40 days overdue. You can sue them. You can sell it to a collection company. So you hate to take legal action simply because you want a good relationship with these people. But if they don't pay their bill, 40, 50 days past when it's due, then you have to. But you know, you wouldn't just like slam them to court. You'd call, you'd put it in writing once or twice. You'd try, you'd really try. But at the end of the day, yeah, it can cost you some money in taking legal action. We're going to get into it later in the chapter as well, but you got to take a look at their credit history. You know, if you're going to go start having $1-2 million IOUs running around, you better look into their history of repayment. And so if they're too much of a risk, maybe you don't sell to them. So it's a big one. Good question. I'd say the legal attack is kind of that last straw. Right. Absolutely. Let's go on to the next one. So on July 5th, we sold it on July 1. But on July 5th, Polo, who's bought it from us, returned $100 worth of merchandise. Okay, so I don't know if I'd write it right there, but find a good spot. If I am an AR and I put $1,000, I've got $1,000 that they purchased, and if all of a sudden they knock on my door and say we want to return $100 worth, you're going to see that be a credit. So now they technically only owe us $900. So who remembers? We know that $100 is going to, $100 is going to be our credit. What's our debit? Do you guys remember what it's called when they return stuff? We sold something to them. Sales returns and allowances, absolutely, of $100. Now remember how annoying it was when we were buying inventory? It was all masked as inventory. Ugh. And you were trying to remember, is that the freight? Is that us returning? On the sales side, it's a little bit easier. You could argue that the inventory when we were buying was easier, but there's just more accounts here. So sales revenue or sales returns and allowances are our debit. And then we just saw with the T account that I drew, accounts receivable is our credit. They owe $100, $100 less. Sales returns and allowances is a contra revenue account. It's offsetting our revenue. Remember, revenue is a credit. If I pop back a ways, we see sales revenue of $1,000. Do I really have $1,000 of money in anymore? No, because $100 was returned. And so that's a contradiction or a contra account to sales revenue. Okay, then look at what day they paid us. On July 11th, we received a payment from Polo for the balance due. First of all, what did they owe us? Why is it $900, not the original $1,000 sale? They returned. Look at the dates for me. And look at the terms. Did they pay within the discount period? They did. Why do you think we offer discounts? Come on, pay quick. Is it worth a 2% off discount? Probably, because we have our money there. Plus, you know what, on the flip side, it leaves happy customers. They're like, oh, 2%? I get 2% off if I pay early? I'm going to keep going to them. Okay, and so it's a win-win for both parties. Certainly as it becomes a liquid asset now and it's cash in our pocket instead of this free-floating AR. So what's our transaction going to look like? Well, cash in our pocket was $882 because remember they owed us $900, but we gave them a 2% discount, so 900 times 2% ends up being this. Well, what they 900 times 2% is what they didn't have to pay us. Okay, and we gave them the $18 discount. Okay, this is a debit, and much like the sales returns and allowances, this is a contra revenue account again. So you mean to tell me we had this $1,000 sale and we had two hits against it? In the previous transaction, we let them return stuff. Can we be snarky about it and not let people return? Is that going to leave for very happy customers, though, who are going to probably pay their bill and throw us under the bus? Okay, so we let them return. And then in the second one, we had another chop to the 1,000 because we let them off the hook on $18, the 900 times the 2%. Is another contra revenue account. So then what's our credit here? Accounts receivable. They no longer owe us that $900 remaining balance because they paid it. It's important, though, that even in your head you do this. Because can you see where if you didn't think about that $100 return, the whole thing would have been off? Because then it would have looked like they had a $1,000 balance. Not good. Last one. It's kind of a fun one to talk about. Assume you owe $300 at the end of a month and the retailer charges you 1.5% on any balance. Here's what we're talking about. Either in your notes find this or in the book find this, page 431. I want to quickly do this because this is driving me nuts. I don't know if it's going to help because my resolution's off. Oh, it is better. Okay. I'm on page 431. I would say most major retailers have what are called store credit cards. Don't get sucked into them. They are truly a trap, a financial trap. They mentioned JCPenney, but let's give some other examples. Scheels, Kohl's, Cabela's. Okay. Let's mention we're Cabela's card holders, so that's a good example. Okay. What does Cabela's do for the Mars family if we swipe our Cabela's card? They're going to give us Cabela's points. Woo, like $10 off after we've spent some $1,000 on their card. Okay. Kohl's allows extra discounts. Like they'll give you certain coupons if you spend X amount of dollars. Okay. Scheels. Next time you go into a Scheels, look for this table. There's a table set up, kind of a booth-like. It looks like they're just like literally giving away stuff, because they are. If you sign up for a Scheels card, guess what you get? A Scheels t-shirt. And if it's at Christmas time, maybe you get a Scheels bear. Right? Do any of you know what I'm talking about? Yeah. Is that t-shirt so great? No, because you know what all of these cards come with? A super extreme interest rate. Like in the 20 to 30% usually. Yuck. The cards look ugly. Yep. Now let's talk about Chevy, GM, Delta, Sun Country. They all have credit cards that more money you spend, you get what? You earn airline miles, or you earn credit towards a new car. You got to really swipe a lot to earn yourself those miles or car points. Okay. What I'm posing down here, interest revenue. So this is a new type of revenue, not really new, but just reminded of it. So far we've had sales revenue. Interest revenue is often substantial for retailers. Why? Why are these retailers with cards making so much money? Are the cardholders religiously paying their bill every month and paying off the whole thing? No. It's a epidemic in our society, the notion of plastic and swiping. And it's very scary. But you know what? There's money to be made. And so on the business side of it, why wouldn't they offer store cards? You know, it always floors me, and there's nothing wrong with it because I understand the marketing side of it. I do. You know, like if I run into Target quick when I'm in Alec and buy just like a couple things, maybe my bill is $10, $15. I'm ready to, you know, swipe my bank card that's coming right out of my bank account. Are you they'll stop. Are you interested in saving 10% today by opening a Target Red card? It's like, are you really trying to get me to save 10% on $10 here today? You know, and I get it. I understand the marketing behind it. Oftentimes, employees who are having to push for cards get incentives. I know we did at American Eagle. For every card that we opened at our terminals, we got huge kickbacks for that. Money, more time off, more of a deeper discount on clothes. I mean, it's very manipulative, but it's very much a part of our society. Right. Right. I know. Yeah. Yes. Yes. What do they do at Herberger's? Maybe you guys don't shop at Herberger's, but I do. Chocolate bars. Yep. The beautiful Godiva chocolate that's wrapped in gold foil, and they're stacked high at all the terminals. And all you do is you're staring at that Godiva chocolate. And it says right on there, just like Morgan described, if the sales associate does not offer you a store credit card, we give you a Godiva chocolate for free. And I'm always ready to pounce. Like I'm ready, you know, they're like doing their spiel. I'm like ready for them to not say it. And I'm like, wham, where's my chocolate? I got it one time and I felt like I really won. But more, they're just trained, like almost robotically trained to get us to try to do it. It's like, well, are you going to give me a Godiva chocolate if I do sign up for your card? Probably not. I worked at Herberger's for a time too, and they were really, really manipulative. If we wanted an employee discount, we had to sign up for a card. And the only way they gave us employee discounts is if we used our Herberger's card. Talk about manipulative. Ugh. So, as juniors and seniors ready to head out to this big scary world, this kind of stuff, these in-store retailer cards, are so tempting. Not worth it. If you're questioning it, come to my personal finance class and I'll put you in front of Dave Ramsey. And he will like go ballistic on you, right? Folks who have taken the class. Oh, he's just plain crazy, but so entertaining. He has this giant scissor that, when I was teaching that unit though, I let Wyatt in my class cut up my Cabela's card right in front of me in the class. It felt good. So back to this. The journal entry is very easy. So if you're rocking some $300 retailer card balance at the end of the month, they're going to charge you, and I don't know where you can find a credit card that only charges 1.5%. If it's got Shields or Kohl's attached to it, it's more like 20%. Okay. What's the entry? Well, we'd take 300 times 1.5% to find out that AR goes up and interest revenue goes up. Now, we are the retailer in this case. We are the retailer. We're not the sucker who got lured into this credit card. We apparently found a sucker to sign up for ours. Okay, so we're the retailer. Jordache, is that what we're doing? Is the retailer. So whoever our customer is, they now owe us $4.50 more, and we have a new type of cha-ching, cha-ching, cha-ching in our pocket. So far we've been rocking sales revenue, but now we have interest revenue. Interest revenue on our store card. Some of the big ones make it like, you know, Cabela's, for example. There's a Visa logo on our Cabela's card. I believe it's Visa, that or MasterCard, whatever. They've got a little contract with Visa to say, go ahead and use it wherever you want. You don't have to just use it at Cabela's. You can use it wherever you want. Because if you use it more, then you're going to have more Cabela's points. Woo! So some store cards are exclusive to that store. But then all of a sudden, if they become part of a major credit card retailer and you can use it anywhere, oof, that's where things spin very quickly out of control. And 1.5% on many, many, many thousands of dollars worth of a balance is not money in your pocket anymore, because now it's owed to them. What's that? Like a gas station credit card. I would assume almost anywhere you go, you can get yourself a credit card with the people. So I posed this question yesterday, but do you think every AR pays their bill every time? Then what happens? It goes into a holy mess for someone to track them down. We call again, we email, we put something in writing in the letter format, then we send another letter format. 40 to 50 days out, you still haven't heard, then what? The two big options here, and that's what we're going to talk about tomorrow. We have what's called a direct write-off, which is not favorable by GAAP, or in other words, generally accepted accounting principles, thinks you should really go for the other option. We have what's called an allowance for doubtful, and I always cross off doubtful and put hopeful. The book calls it allowance for doubtful accounts. I always say the allowance for hopeful accounts because I hope I can get my money. As far as balloons go, and I'm going to bring balloons tomorrow. So here's one balloon. Here's another balloon. On a direct write-off, we pop a balloon, like gone. We're done with you. On the allowance, we maybe take out a little air and deflate it so it's looking more like this. Okay. We take out a little air and we go, okay, we're going to walk away from you for a little bit. We're going to send you off to collections, or we're going to work with you in hopes of eventually recovering our money. The problem with this one, if you pop this balloon, it's done. If you just let out a little bit of air, you could recover it. So that is tomorrow's preview. I know no, you're not in this class tomorrow. Thursday's preview. Okay. The lecture will likely take me the whole hour to explain it and to talk about all the intricate journal entries that go with it. Okay. Today, I want you to do 2 exercises. You have time, I think you do. I want you to do exercise 9.1 and exercise 9.2. I'm going to do just a couple with you, and then I'll give you some work on your own, and then that's when I can call you up one at a time to take a peek at your notes. So exercise 9.1, you can find this in your workbook. If you'd rather just write it somewhere, that's fine too. In the book, I'm on page 455. Presented below are selected transactions of Molina Company. Molina sells in large quantities to other companies and also sells its products in a small retail outlet. On March 1st, we sold merchandise on account to Dodson. Now, your Chapter 5 brain says sold. I have 2 transactions, but remember we're omitting the inventory going down and COGS going up bit. So if I sold merchandise on account to Dodson for $5,000, our AR to Dodson is going to go up, and sales revenue will also go up by $5,000. If it helps you to have a little AR chart here as they potentially return stuff, that might not be a bad idea. Because on March 3rd, they're already coming back to us and saying, Dodson returned merchandise worth $500. So we see AR go down and now they only owe us $4,500. So if they're going to return stuff to us, I see that here's our credit. AR has to be the credit, and we learned in the chapter what's our debit have to be. It's a contra revenue account. Sales, returns, and allowances. And now AR doesn't owe us quite as much money anymore. I want to get through this March 9th, and then I'll let you work on your own. So on March 9th, Molina collected the amount due from Dodson from the March 1st sale. Let's look at a few things. What do they owe us right now? Is it $5,000? No, they owe us less. And my question is, did they pay within their 210 and 30? So what kind of a deal are we going to give them? 2%. So you see cash and a sales discount equaling this $4,500 that they owed us. I am going to circle, or you should star, we have sales discount or sales returns and allowances and sales discounts. Those again are debit balances that are contra revenue accounts, because remember, revenue has a credit balance, so these are kind of chopping that up a bit. But you know what? We need happy customers. We need them to be able to return, and we need to give discounts if they pay early, because that's a win for us. If they pay within 10 days, that has been a very liquid AR. Boom, money's here. Is it worth $90 to have that money here fast? We're pretty nice. We're pretty nice, but you know what? Then it's done. We don't have to worry about writing them off or hoping that they'll pay us. So I'm going to let you just keep working. 9.2 is a little bit like, you'll see it. It's like many transactions in one.